In this video, I intend to 1. Acknowledge the real benefit of philanthropic giving, 2. Share a surprising stat on the lack of tax deductibility of charitable giving, and 3. Provide some examples of planned or strategic giving that does good and helps save taxes. Charitable giving is so good. It is good for those in need of the support, of course, but the Cleveland Clinic reports that giving can lower stress, lower blood pressure, combat feelings of depression, and even lengthen one's lifespan. Maya Angelou went even further, suggesting that among its other benefits, giving liberates the soul of the giver. So really, giving's not just good, it's great. Let me encourage you to find a cause you support and give generously of your time, money, or talents. Having highlighted the real reason to give, as a financial planner and a wealth advisor, it is not lost on me that people also like the benefit of tax deductions that are offered to those of us who give to charity. But did you know that only 30% of people who donate to charity actually receive a deduction for their annual gifts? It may be worth checking your own tax return to see if you are or aren't. If not, hopefully an idea shared here today may benefit your giving strategy moving forward. The primary reason people do not receive a tax benefit for their giving is because they aren't itemizing their deductions. Why not? Well, because you have to beat the standard deduction for it to make sense to itemize. Let's take a look at what are the allowable deductions for itemizing. 1. State and local taxes on property. Importantly, this was capped at $10,000 back in 2017 under the Tax Cuts and Jobs Act. 2. Mortgage interest, available on the first $750,000 of loans. Another is doctor and dental expenses exceeding 7.5% of your adjusted gross income. And finally, charitable contributions. Here's a quick example. Married couple Tom and Sue filed jointly. The following details pertain to their 2024 itemizable deductions. A $10,000 state and local taxes. Even though they paid more, they hit that $10,000 cap. $11,700 of mortgage interest. No qualifying medical expenses. And $6,000 of charitable contributions. Because their total of $27,700 of deductible expenses does not beat the 2024 standard deduction of $29,200, they would use the standard deduction. With sufficient savings and investments, we encourage Tom and Sue to utilize a tool called a donor advised fund to make 5 years of charitable donations all in 1 year, a strategy called bunching. Here's what that looks like. Again, $10,000 of state and local taxes. Even though they paid more, they hit that cap. $11,700 of mortgage interest, no qualifying medical expenses, but then $30,000 of charitable contributions. Now, with deductible expenses of $51,700 exceeding the standard deduction, they will itemize. Before offering another example on maximizing your giving strategy for tax benefit, a quick note on the Donor Advised Fund for those who may be unfamiliar. It is a vehicle in which you can transfer cash and or securities for which you will receive the full tax benefit of the gift in the year it is made, but allows you to distribute the funds to your choice of qualified charities over time, meaning you can recommend grants out of the Donor Advised Fund for years to come. Now, about that additional strategic nugget on maximizing your tax benefit. Consider that Tom and Sue had enough saved in cash to make their $30,000 contribution to the Donor Advised Fund. Their benefit would work like this. Assuming a federal marginal tax rate of 32%, their gifts saved them $7,200 in taxes, that is, itemized over the standard deduction. This math suggests that it's effectively cost $22,800 to give $30,000 after the tax savings. What could be better than that? Well, Tom and Sue also had a technology stock, which had, over the years, grown from their original investment of $10,000 5 years ago to just over $30,000 now. Given their situation, I encourage them to donate the stock to the Donor Advised Fund instead of the cash. Why? Well, check this out. By donating the shares of the stock, Tom and Sue were able to recognize the full deduction of their $30,000 gift, like in the cash example, but had the added benefit of eliminating the taxable gain on their stock position. Assuming a 15% long-term capital gains rate and a 4.5% tax rate, this strategy of gifting appreciated stock generates an additional tax savings of approximately $3,900 on the gain above and beyond the $7,200 total deduction. I'll note it's very possible, based on income, that the capital gains tax savings could be higher still. Interestingly, Tom and Sue still believed in the growth potential of the technology stock, so we took the $30,000 cash they'd considered for the gift and repurchased the stock, adding one more benefit to this scenario, in that they were able to maintain the same position in the stock, but now having reset their cost basis higher. In other words, they now have the same position in the stock, $30,000, but have eliminated the gain to keep taxes lower if they decided to sell the position later. If you find yourself with a desire to give and want to investigate doing so strategically for tax benefits, reach out to our team at Professional Planning and Wealth for a conversation on how we could help create a plan.